Hello everyone, this is Ali from Turkey, and today I will be presenting you the impact investing and venture capital financing presentation, which was prepared for the project Impact Academy. Here we see the objectives. It's becoming aware of the problems created by the understanding of output investment, understanding impact investing and its importance, comprehend the financing problems of startups and venture capital, and understand the importance of financing venture capital. And at the end of this module, you will be able to comprehend the basic concepts of impact investing and venture capital financing, understanding and analyzing the difference between impact investing and output investing, comprehend and evaluate the consequences and importance of impact investing, to be able to understand the financing problems that startups may encounter and to evaluate innovative financing methods, and ability to comprehend and evaluate venture capital financing. Let's start with the Unit 1, Impact Investing. It is an extroverted investment strategy in which investors seek to achieve a financial return while also achieving a direct positive environmental or social outcome. Global Impact Investing Network defines impact investing as investments made with the intention of creating positive, measurable social and environmental impact along with financial returns. Every investment contributes to positive and negative social and environmental impacts, both in the short and long terms. All investors shape these effects through their investment decisions. Impact investing is therefore an approach used by investors to harness the power of their invested capital to actively contribute to improvements in people's lives and environmental health. It needs clarity. There are four key characteristics of impact investing. Intention. The impact investors intends to make a positive and measurable contribution to the solution of social and environmental problems with its investments. This sets them apart from other strategies such as ESG investing, responsible investing, and screening strategies. Financial returns. The impact investor doesn't invest for the purpose of grants, but for the expectation of receiving a return, at least in the amount of his capital. Impact investing is an investment approach between traditional investing, which seeks to maximize profits, and philanthropy, which seeks to create environmental and social impact without considering financial returns. Return expectation range and asset class. The impact on investors' financial return expectation is below the market return or at the risk adjusted market return rate. There is no limitation on the asset class. Impact measurements. The hallmark of impact investing is the use of evidence and impact data in investment design, the transparent and accountable measurement of social and environmental impact performance and progress, and a commitment to contribute to the growth of the industry. Based on general definitions, impact investing is defined as a strategy to generate financial returns in line with the investor's own expectations, with the intention of creating measurable impact towards the solution of one or more of the existing sustainable development problem areas through projects or initiatives that are financed by investors possible. Impact measurement and impact management have two separate functions and complements to each other. The OECD divides the current initiatives that support each of these functions into four broad groups. 1. Frameworks and methodologies. Frameworks provide a structure to facilitate working in accordance with the principles and guidance during the implementation phase. Methodologies draw a systematic path and establish a procedure for applying principles within a specific framework. Standards, certifications, and ratings. The standard requirements are based on best practices agreed through an international accepted process. Certification usually include a third-party verification to ensure that a company or investment meets a certain standard. Ratings are the rankings of companies or investments based on a comparative assessment of the level of achieving a certain standard. Metrics and indicators. These are standardized numerical elements used to measure, track, or compare investments. Databases of standardized, defined, or widely used indicators and metrics that can be applied by investors and companies. And lastly, principle and guidance. Principles are a broad set of agreed values that bring about a common understanding of ethics. Guidance is needed to further elaborate on the principles. Section 1. Basic Principles of Impact Investing. Key features of impact investing complement a global impact investing network. Definition of impact investing. Refined in collaboration with the world's leading impact investors, the four key characteristics allow for greater definition of key expectations for impact investing. These principles are as follows. They intentionally contribute to positive social and environmental impact through investments as well as financial return. They use the evidence and impact data in investment design. The best quantitative or qualitative impact data and evidence should be used to increase the contribution to positive impact. This includes to identify a social or environmental need that is consistent with empirical evidence or well-established science, as well as a need expressed by the population or environmental community that the investment seeks to serve. Set targets related to the contribution of the investment to the improvement of this need. To design investment strategies based on effective solutions in addressing the identified needs and to ensure that the potential negative effects in the context of investments are understood. To determine the qualitative and quantitative indicators that we will use to measure performance against our targets and to impact analytics over time to improve the rigor of activities. Management of impact performance. Impact performance data should be used in decision-making processes to manage investments to achieve social and environmental goals. This includes embedding feedback loops as possible throughout the life of the investment, identifying risks and develop mitigation plans to achieve stated impact targets, and trying to mitigate the negative consequences of actions. And lastly, contribute to the growth of impact investing. Action must be taken so that more investors can make impact investments effectively. This includes to be transparent about the degree of use of these impact investing practices, to commit to using common contracts, approaches, and standards to define impact objectives, strategy, and performances, to consider the impact performance and quality of impact management practices of potential co-investors and invested businesses in the decision-making process, and to share positive and negative learnings and the evidence or data that are not proprietary or proprietary. Section 2. Types of impact investment. Impact investments aim to contribute to the solution of existing economic, social, and environmental problems with the invested business. In this context, it is possible to classify impact investments as initiatives that aim to create value economically and socially. Impact investing can be classified based on financial return and expectation of impact. Traditional investments. These are the investments where return is targeted at the market level and there is no impact target. Philanthropic investments. These are the investments in which measurable impact is the main goal and the expected return on investment made is negative. Responsible investing. In these investments, we act with the principles of sustainable investment, sustainability, and non-harm. Absence or negative externalities of investment is wanted, and while aiming for desirable and unmeasurable positive effects, the return on investment is aimed to be at the market level. And impact investing. Impact investing differs from venture philanthropy in that it targets positive financial returns provided that measurable impact is achieved. The prioritization choice that investors will make between financial return and impact level will be the determinants of the impact level and financial return rate to be obtained as a result of the investments. And Section 3. Dynamics of Impact Investing. The determinant of impact investing is market dynamics. There are three main factors that determine the dynamics of the impact investing market. These are supply, impact, and demand. The supply side is a source of funds and asset managers needed to realize impact investments. Impact side shows the financing tools of investments, and the demand side is made up of impact investing organizations and service providers. And section 4, the future of impact investing. As the impact investing landscape has matured, the performance of leading impact funds has been crucial to building credibility and best practices and paving the way for future managers. Factors such as high level of ownership of the 2030 Agenda for the Sustainable Development by all countries, the urgency of issues such as social justice and climate change, strengthening social movements, and the global pandemic positively affect the development of the impact investing market. And Section 5, Impact Investing Challenges, Risks, and Goals. Despite the positive outlook and expectations for the impact investing market, there are a number of risks and obstacles to market development. Overcoming these risks and obstacles will help the industry reach a much better point. Section 6, Impact Investing Financing and Financial Instruments. Inequality of opportunity, income inequality, access to education, housing problem, and environmental pollution are common problem areas of developing countries. In order to solve these problems, the importance of entrepreneurship and innovation, especially social entrepreneurship, is increasing. In this context, many initiatives are emerging in many developing countries to produce innovative solutions to economic, social, and environmental problems. The impact investor of these startups may choose one of the investment instruments according to variables such as risk appetite, return expectation, level of desire to make an impact, and return on investment. It will be compatible with the structure of the organization that will receive the investment. And Unit 2, Venture Capital Financing. Venture capital has a historical starting point and a tendency to develop based on this beginning. George Storiot, considered the father of venture capital, founded the American Research and Development Company in 1946 to invest in companies that commercialized technologies developed during World War II. The company first invested $200,000 in a company that had a claim to use X-ray technology for cancer treatment. When the company went public in 1955, it returned 1,800,000. This development has led to a massive drive towards venture capital. Venture capital has been adopted and spread in countries where the technology-based industrialization strategy has been adopted, especially in the USA. Section 1. What is venture capital? Risk capital, in general, it is a financial method that is dynamic, creative, and innovative, which allows operators at all stages whose financial power is not sufficient to realize their investment ideas, provides business and management expertise support when necessary, and provides capital transfer in return for shares. The concept of the private equity and the concept of venture capital can be used synonymously, although there are differences between them. Private equity funds are pools of capital to be invested in companies that offer an opportunity for a high rate of return. Financial venture capital can be presented as venture capital companies, investment banks, and other financial institutions, high net worth individuals, angel investors. Venture capital firms create venture capital funds, which is a pool of money raised from other investors, companies, or funds. A venture capitalist can be a single investor or a group of investors who come together through investment firms. For example, venture capital is established in Turkey in the form of a venture capital fund or venture capital partnership. How does venture capital work? Venture capital is a type of private equity investment that involves investing in early stage businesses that require capital. In return, the investor will receive an equity stake in the business in the form of shares. Private equity investments are equity investments that are not traded on public stock exchanges. Institutional and individual investors often invest in private equity through limited partnership agreements, which allow investors to to invest in a variety of venture capital projects while retaining limited liability of the initial investment. Venture capital funds are managed similarly to private equity funds, where the portfolio of companies they invest in typically falls within a particular industry specialization. A venture capital fund is usually structured in the form of a partnership where the venture capital firm and its managers serve as general partners and investors as limited partners. Organizations that offer venture capital invest in a company until it reaches a significant position and then exit the same position. In Section 3, Types of Venture Capital. Venture capital can be classified in different ways. Risk capital can be classified according to the stage at which it is invested. Pre-seed accelerator stage capital. The pre-seed stage is the capital provided to an entrepreneur to help them develop an idea. Many entrepreneurs interested in securing venture capital funding will engage in business incubators, which provide a variety of services and resources for entrepreneurs to connect with venture firms and networks that will help them develop their business ideas and products. Seed stage capital. Seed stage capital is capital provided to help an entrepreneur turn their idea into an early stage product. Seed stage capital typically funds research and development of new products and services, as well as research into possible markets. Early stage capital, which is startup capital. Early stage capital is the venture capital provided to establish the first business and basic production. Early stage capital supports product development, marketing, and commercial production and sales. Expansion funding. Expansion capital is the funds that a company needs to expand its operations. The funds can be used to enter new markets, create new products, invest in new equipment and technology, or even acquire a new company. Bridge funding. It is a capital that has promoted its products in the market, reached a certain market share, and is intended to provide the funds needed by the business in the process of going public. And risk capital features. Some of the characteristics of venture capital include: not for large-scale industries, venture capital is offered specifically to small and medium-sized enterprises, invests in high-risk, high-return businesses. Companies that are eligible for venture capital are usually those that offer high returns but also high risk. Offered to commercialized ideas. Those who prefer venture capital often seek investment to commercialize their idea about a product or service, abandoning investment to raise capital. Venture capital firms or other investors may stop investing in company after it has shown a promising turnover. Cutting off investment can be carried out not to make a profit, but to provide more capital. Long-term investment. Venture capital is a long-term investment where returns can be realized after 5 to 10 years. And Section 5, Advantages and Disadvantages of Risk Capital. Venture capital, which doesn't have enough cash flow to borrow money, it provides financing to new businesses. This arrangement is mutually. It can be beneficial because businesses are able to start their activities, they get the capital they need, and investors get the capital they need. They invest equity in promising companies. Venture capitalists are often skilled staff and advisors mentoring and networking them to help them find services. A strong venture capital backing can be used for investment. However, a business that accepts venture capital support may lose creative control over his future direction. Advantages of venture capital. And here we see launching operations for early stage companies, provide capital, secure companies' venture capital financing doesn't need cash flow or assets to receive it. In other words, entrepreneurs or business owners do not have to repay the invested risk capital. Even if the company fails, it will not be responsible for reimbursement. It helps to make valuable connections. expertise, and through their network of venture capital providers, business can help to build connections for its owners. This can be very helpful in terms of marketing and promotion. Helps raise additional capital. Venture capital investors need to invest in one or more company to increase its valuation. They try to provide excess capital. To do this, they can bring in other investors at a larger stage. Helps in upgrading technology. Risk capital can help small businesses to stay competitive, to acquire new technology that can help or can provide necessary funding for them to integrate. And disadvantages of venture capital. Reduction of the ownership share. This is the venture capital from a share of ownership in the business of entrepreneurs they are to give up. Most of the time, a company will be able to take advantage of the initial forecasts. It may be that it needs higher additional funding. In such cases, the owners can pay their majority shares in the company and they may lose their decision making authority giving rise to a conflict of interest. Investors in a startup own a controlling stake, but also they hold a seat among the members of the board of directors. As a result, between owners and investors, conflict of interest may arise, which can lead to decision making block. They are under pressure. Venture capital can put pressure on companies to come out investments instead of efforts to grow in longer terms. Securing venture capital can be time consuming. Venture capital investors conduct due diligence and evaluate the feasibility of a startup before investing or continuing to invest. This may cause the financing process to be delayed, and leveraging venture capital can be challenging. So, to sum up, impact investing is an extroverting investment strategy in which investors seek to achieve a financial return while also achieving a direct positive environmental or social outcome. These managerial approaches led to extreme pollution of the environment and to changes in seasons, causing an increase in poverty and migration. These results began to provoke reaction, especially in developed societies. These reactions led to increased environmental awareness and to countries to make efforts to reduce poverty and to prevent migration. This framework led to various international conferences, and as a result, international treaties were made. The Sustainable Development Goals set by the UN in 2015 and agreements such as the European Green Deal led to the effective approach of ESG for companies. It has now become important for companies to focus not only on profit but also on environmental factors such as the climate crisis, social diversity and inclusivity, governance issues such as ethics and transparency. That was all from the presentation that was made for the Project Impact Academy. Thank you for your attention and thanks for listening to me.